Okay, now let us look at this band chart. Okay, now this is Sensex P band chart, and it's essentially 1 year forward P band chart. Okay, so 1 year forward P band chart. Okay, now we won't get into nitty-gritty of how do we draw it, but all it tells is that. So if you look at this chart closely, this represents 25 times Sensex earnings. Okay, this represents 20 times, this represents 16 times, this represents 12 times, and this represents 8 times. So all it tells is that had the stock traded 8 times its 1 year forward earnings throughout its lifetime, this is how the stock price would have looked like. So assuming that it will always trade at 8 times, 12 times, 16 times, 20 times, and 25 times, you would see a typical consistency in those lines compared to the actual stock price. So the blue one over here is telling you what is the actual stock price, whereas this 8 times, 12 times are assuming that had the stock traded at 8 times its 1 year forward earnings multiple, then the stock price would have been the one that is seen in the red line. Now with this basic thought process in mind, let us look at what basic observations we can do. Now before we go there, these vertical bars are the GDP numbers. So this is the real GDP growth that we are talking about over here. Now real GDP growth was about 7.6% in 2000, and you would see the Nifty level was about 5,000, which was very high. And you would remember the bubble or the dot-com bubble that we were experiencing at that point of time. So I mistakenly said Nifty. Okay, it is not Nifty, it is Sensex. Okay, so the Sensex level was about 5,000 at that point of time, which was relatively quite higher uh, uh, at that point of time. After that, we entered into a slowdown. Like it was global slowdown, but still India continued to grow at 4.3%, and Sensex level came down, and then it continued to come down to quite a lot for quite a lot of time, and in 2003 it nearly bottomed out. Okay, and after that you can see the Sensex has been consistently growing, and it went to the level of 20,000 in the span from 3 to, I would say, beginning of 8. Okay, so if you see the fall that has started, the fall that happened, it happened from January 2008 onwards. Okay, so you can basically say that till 2007 end or beginning of 2008, uh, the Sensex has been consistently growing. Now this growth is quite justified with the GDP growth. Okay, now we can see the GDP had grown at 8.1%, 7%, 9.5%, 9.6%, 9.3% consistently after 2003, and to a certain extent you can definitely give credit of this to the growth in GDP, the credit of Sensex rise to growth in GDP. Now you can also see that after that Sensex had fallen. Okay, now Sensex started falling well ahead of time. The bad number, which was 6.7 compared to earlier growth rate of 9.3, actually came in, and Sensex had already reflected that, and well ahead of time the actual next year GDP growth of 8.6 and 9.3 came in. Sensex had already rebounded, and now we are experiencing again a slowdown in growth, which is 6.2% in 12 and 5% in 13, and probably little less or somewhere equivalent to 5% growth we are expecting in the financial year 2014. Now given that, you can still see the Sensex is maintaining a similar level. Now there are a lot of thoughts that whether Sensex is overvalued, undervalued, and fairly valued. Okay, there is one thought process that goes in the markets is that if Sensex is somewhere around 14 to 15 or 14 to 16 times its 1 year forward earnings, then Sensex can be said as fairly valued. So if we assume that the Sensex is currently trading somewhere around 16 times, and one of the thought process could be the Sensex trading fairly. Okay, so now let us give a further thought to it and try to connect Sensex level to the earnings. Okay, now another thing, okay, is that, okay, before that let us look at this. Okay, so now we are in 2000 and we are trying to connect 2000 numbers with that of 2001 2000's earnings. Okay, so 2000 growth was 1%. Okay, and in 2000 Sensex was somewhere around 5000 level. So let us keep this as a benchmark. And in then 2001 the growth was negative, which was minus 23%. The growth was not very high in earnings of Sensex, which is 9% in subsequent year. So you would see the Sensex has been falling consistently since then. So 2001 was a poor year, 2002 was again a flattish year, and 2003 the Sensex actually bottomed out. Sensex bottomed out in 2003, whereas earnings growth was relatively good. Now, when the earnings growth was 15%, the Sensex was trading somewhere around 8 times. Okay, now people who believe in peg valuation uh, may say that this was not justified, and that was the reason that Sensex started bouncing back. Now, that was not the only thing the Sensex bounced back, but the other reason was that 2014 earnings were expected to be 28%, 29%. Okay, so you would see consistent years of higher growth. So 2004 was a higher growth, and you would see Sensex rising in 2004. 2005 was a higher growth of 29%, and Sensex grows to the level of like 12 times of its 1 year forward earnings. And then consistently Sensex has been growing, and you would see the highest growth happen in 2007, and you would see Sensex was consistently climbing, and in 2007 March the growth was 37%. And with respect to 37% growth in 2007, so if you look at where the Sensex was trading a year before, it was trading about 16 times. Now let us go ahead and look at how the Sensex was trading at the end of 2007. Okay, so at the end of 2007 the Sensex was trading about 16 times. So if you look at 2008 earnings and apply the basic thought process of peg equal to 1, then you would see at the end of 2007 also the Sensex was trading somewhere at a similar level of peg of 1, which is 16% growth in earnings, and Sensex was trading 16 times. So the Sensex was fairly valued somewhere around 2007 as well, assuming that 1516 is the fair multiple. Okay, now if you look from 2007 31st March and look at this time period, now this time period it was trading at 25 times. Okay, now it was somewhere between 7 and 8, it was trading between 25 times, whereas actual growth in earnings in 2009 came in at minus 2%. Okay, so if we connect this, okay, then I think peg ratio may not be valid, but what it tells is if we try to calculate peg ratio over here, the Sensex was trading at 25 times, whereas earnings were negative. Okay, so means the even if we assume the earnings growth was very little positive of 1%, then it is also 25 times now, or 25, which is significantly higher than the fair level of 1. Now it was naturally saying that this level was overvalued, and which was also reflected in next year earnings, and you would see the Sensex corrected to the level of between 8 times and 12 times of p bands. Okay, now whether this level was correct, okay, now there is another big question. Okay, probably this level was oversold. Okay, and you would see the Sensex bouncing back from here to the level of 16 times in a very sharp manner. Can you see, in a matter of few months the Sensex had bounced back. The Sensex had bottomed out in March 2009, and uh, after that it just bounced back to the fair valuation level of 16 times uh, in financial year 2010. So here now let us look at financial year 10 numbers. Okay, financial 10 numbers showed 1% growth in earnings. Now again, 16 times versus 1% growth in earnings, it may seem little overvalued in itself, but you would see the expectations the stock was reflecting was probably a combination of not 1 year but 2 years. So if you look at 2 year earnings growth average, that turns out to be about 14 times, and with that 16 times, so it was I would say 16 upon 14, which is, I would say, it was slightly overvalued. And since then you would see Sensex has been trading in this range. Okay, and even if we look at currently, the Sensex is also trading at 16 times its 1 year forward earnings. Now what we have factored in over here, okay, is that we have factored in 8% growth rate in 2014 numbers and 13% growth in 2015 numbers. Now these are not our estimates, these are some publicly available estimates, and we don't want to give names of which particular brokerage house, but some of the brokerage house have assumed 1260 as the estimated earnings number, and 1424 as estimated earnings number for 2015. So if we do a rough calculation of 16 times of 1424, okay, 16 times 1424, how the stock should be valued. Now if you were to do this calculation quickly, I'm just quickly using a calculator for doing this calculation. We said 16 times 1624, sorry, 1424, that number is 22,784. Okay, so this number is 22,784. Now assuming that 16 times is a fair level, okay, 16 times is a fair level to trade for the markets. Now there is a hitch in this entire thought process. Okay, now first of all we are saying that 16 times 1424, typical range that is looked at is 14 times to 15 times. Okay, now how this range is decided, okay, now it is historically evidence ranged. Okay, there is no specific basis for that why it should be 14 times and 15 times. Okay, so normally the P multiple should be given keeping in mind the growth in earnings. Okay, so if we are sitting somewhere on 31st March 2013, okay, and we want to look at how the Sensex will be trading on 31st March 2014. Okay, so what I will look at is the average earning growth that is expected in the next 2 years. Okay, so average earnings growth expected in the next 2 years can be calculated by using these two numbers, which is 13 plus 8 is 21, so approximate growth is 10%. Okay, so with the fundamental thought process that peg of 1 is fairly valued, if you say 10 will be the P, so that the peg ratio becomes 1, then you are actually looking at 10 times P multiple. So if you look at 10 times P multiple, so let me just clear this out all. Okay, so if I'm saying that I'm looking at 10 times 1424, okay, then my valuation comes out to be 14,240. Earlier we had said that we are looking at 16 times 1424. Okay, now this 16 doesn't have any basis. Okay, it is generally said that 16 times of 1424 is fairly valued. Okay, so and it was giving us some number which was 22,000, approximately 22,400, a number that we calculated sometime before. Now what do we really want to go ahead with? Okay, now real difficult question. Okay, now most of the time people think that valuation is a function of uh, earnings. Okay, and many times you would see that valuation is not actually a function of earnings, as we saw over here, that over here the Sensex was. Okay, now we had seen over here that assuming 16 times was a fair number, the market were fairly valued on 31st March 2007. We had said that on 31st March 2007 the next year earnings were about 16 times. Okay, now with 16 times earnings growth and p multiple of 16 gives you peg ratio of 1. That's why we had said the markets were fairly valued. And if you look at the earnings growth for 2009 and 10, the growth was really poor over here, but despite of that the markets really went up significantly higher. Okay, and despite of the fact that 11 numbers and 12 numbers were not so bad compared to earlier years, the markets actually corrected in this approximately 2 years or one year span uh, to the bottommost level. Okay, which was near 8,000 level, 7,500 level. Now there is some irrationality in both the thought process. So one at one place you can say that this growth that we saw in the market was irrational from here to here, and probably you can see from here to here, which I will mark as a span. Okay, so let me just, so now this growth was probably irrational. Okay, again the assumption is that 16 times is fair multiple, and then this fall probably was once again relatively irrational. Okay, now there will be some still logics why the market fell down. Okay, so you can see this patch people had huge grid. Okay, and over in this patch people were really afraid, so there was a lot of fear in the markets. Okay, now coming back to discussion, 16 times. Okay, now you need to always remember that on what basis you are saying 16 times. Okay, so 16 times when you are saying fairly uh, a fair multiple for the markets, this needs to be justified by the growth in earnings. Okay, as we saw over here, the growth in earnings was almost the same. Okay, I'm not saying that if 16 times, if we give 10 times, the market are going to remain at these levels only and they will not break out, something like that. Market is a function of lot of things. Okay, but I'm just talking of some fundamental parameters, that why things are happening the way they are happening. Okay, and how you should look at markets at this stage currently. Now as per our earlier discussion, we said that the if you look at the next 2 years growth, which is 13% and 8%, and if you take its average, so it turns out to be 10%. Okay, or 10 point or 10.5% approximately. And so for you to have a justified p multiple, all the multiple that you can give to is, so that the markets are fairly valued, is 10, so that the peg ratio is 1. Okay, so with all those thought process, the markets currently over here look little overvalued. Now to support that argument will also come the GDP is also falling down, inflation still is not in control, and interest rates continue to be very higher. Now with all this thought process, probably 16 times multiple in this time period may not be that justified. Okay, probably there is some scope for correction. The markets may correct to the level of 12 times. I'm not saying it will go to the level of 8 times, and whole lot depends on how these earnings pan out. Okay, so if instead of 1260, if the earnings growth comes at 1200 level, okay, then this EPS estimates is further downgraded. Now with EPS estimates downgrade, your 16 times uh, number will get revised down to the extent the earnings have been revised. Okay, so that is what I think about how the Sensex is valued right now. Okay, uh, so if you want to look at, so if you look at the entire chart, which level was really justified? Okay, probably on peg basis we can say this level seems to be justified at this point of time. Again, because we are getting, so on 31st March 2007 the P multiple for the next year was 16. Now this is in the hindsight. Okay, so if you actually look at what was this number, okay, in reality, okay, the people would have given a number of 1,000. So analysts would have given a number of 1,000 EPS, and which actually came in at 833. So with that level, so if I just want to draw a line from this point horizontally, the market was somewhere between 10,000 and 15,000, so somewhere near 13,500 odd. Okay, 13 14,500 odd. Okay, so at that point of time, 13,000 divided by earnings of 1,000, the P multiple was 13 times. Now 13 times on the backdrop of 16 times or 16% growth in earnings, uh, no, I think the growth number would have shooted up over here, so probably the growth would have gone to the extent of 20% over here. So this needs to be corrected. So 13 times on the growth of 20% looks very undervalued. Okay, so you really need to see how this 1,000 number or how this earnings growth number has been arrived, and what is downside risk and upside chances in these numbers. Okay, so probably most of the times people were expecting 1,000 number over here, and that's why the markets looked still undervalued. Okay, and that's why you saw so much of rally. So this is in the hindsight, the number looks 25 times over here, but analysts would have given earnings growth that was significantly higher at that point of time, and that's why these valuations even look justified even at that point of time. So I still remember when the markets were at the peak, nobody in the market was really ready to accept that markets were really overvalued. And typically you need to also keep in mind the biases the brokerage houses will have. Now they're in their business, so their job is to sell. Okay, but as an investor, you need to always keep in mind the biases the brokerage houses may have when they are saying markets still look undervalued. So that's it for now. Give a thought to it. You may have some different views, different thought processes. Please share. Thank you.